Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth. Wanted to give you one of these flash briefings. This is our new thing we're doing at ALINE Wealth. Shorter form, right at you, topical. In this one, we're going to talk about valuations. What a surprise here at ALINE that we're talking about valuations. Remember the importance of our duality of mission. Our job is not just to make money for our clients in the simplest form, but also to balance the risks that are associated with investing, to protect in times of stress, to make sure that we are focused on the financial plan, the legacy plan, the estate planning. This is what we do. This is the importance of wealth management, the duality of mission. And it's important that we focus both on both sides of the ledger, and we do. Here we go. So you can see it now. We're starting here with this idea of valuation, right? So the concept here, folks, price matters, valuation matters. When you look at all the factors that can affect of investment success, all right, what are the most important things? It's not the, who's in the White House, who's in Congress, what are the interest rates, what's the GDP, all important inputs, but the most important input over time, that's the key constraint here, over time has been the price you pay when you enter the investment, which kind of makes sense if you think about it. If you buy something when markets are high, it could be anything. It could be a house, a car, a piece of art. You're going to have a tougher time, seeing the long-term growth of that asset because you've paid a full price for it. With markets, it's still different because the things are liquid, so things move every day. But clearly, the entry price is a critical input. And over in the short term, it's all about noise. Anything could happen. We're talking about the sort of 5 to 7 year investment horizon. Price matters. This is a slide that talks about the cyclically adjusted PE ratio. You've heard me speak about the CAPE, right? This is Robert Shiller of Yale's Nobel Prize winning research. And he smoothed out the earnings over 10 years, going back to 200 years of research. And by smoothing out those earnings, you get rid of the ups and downs of the business cycle, and you have a better sort of multiple valuation. In this case, the average over the last, 100 years is 17.6. 17.6 is the average. We're 45, 46. Okay. Clearly high, the highest ever. Okay. So what does that mean? Things are fully priced. We know that. But this is where you take that info to the next iteration, right? What does it mean for our clients? What it does mean is that when you start at a high Cape, I mean, the one we have today is not even on the chart. It's literally off the charts. That's how high it is. But if you look at these Capes in the 28 to 35 range, they're below zero. The next 10 years, the average return has been below zero when you go in at an elevated Cape, right? When you go in a lower Cape, however, as you could see from this green box, a lower Cape, you have much higher returns. Price matters over time. We don't work in the short term. We work over time. That's compounding. That's wealth management. I want to talk about another metric in valuation because this has been it's been in my stuck in my cord for a bit here, is this idea of price to sales. And you can see from this slide, we're at elevated levels of price to sales. This has become a new thing now in the markets, where this is a valuation metric that used to be, 2 or 3 times sales at the worst, 10x, crazy town. Now we're 30% of the S&P above that. This is a little dated, but it's probably close to that level, if not higher today. But here's a little bit of a bit of sober news for you. Scott McNealy was the co-founder of Sun Microsystems, and after the dot-com burst in 2002, he had a conversation with analysts. And you can see here what he says. At 10 times revenues, 10 times sales, to give you a 10-year payback, analysts, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I get that by my shareholders, assumes zero cost of goods. Very hard for a computer company to do that, assumes zero expenses. You can read this, right? It is unbelievable. And yet today we haven't learned these lessons. Unbelievable. Here's the .com. Here you can see what McNealy's talking about, and boom. Well, and we saw that a little bit here too. Boom. This is an important valuation statistic to look at. Things are fully priced, if not frothy priced. But that again could last a while. It is not a short-term indicator. It is over a time indicator, which allows us as portfolio managers to say when we're investing our clients' capital carefully and proactively and fiduciary centrically, that we're always going to be mindful of what we're doing, what the market's doing, what's the value, what are we looking at today? And when we do that, we think about what could go wrong, where the puck is going. And that's an important part of what we do. So that's sort of where we're at today. I wanted to thank you for your attention and give you a sense of where we're at on the valuations idea. I hope this is helpful. We're here to help. Thanks very much.